you have been day trading for more than a few weeks, you have probably had this exact experience. You put your stop loss just above an obvious high or just below an obvious low, and price strike into it, takes you out, then reverses and runs exactly the way you thought it would. Today we are going to break down exactly why this keeps happening using one of the most powerful concepts in modern day trading: buy side liquidity and sell side liquidity. By the end of this video, you will understand why prices behave this way, and how smart money use these liquidity pools, and how you can start trading with them instead of getting trapped by them. Let's dive in. First, let's talk about what liquidity actually means in the market. Liquidity is simply the ability to buy or sell without causing a big price move. You can treat them as buy orders and sell orders that lie across different prices. Let's look at a simple example. The original price of a stock is 10. There are plenty of sell orders sitting at 11. So if you want to push the price up to above 11, you will need to fulfill the orders at 11 first, and these are the liquidity. You can treat them as orders that lies on specific prices, so that the prices wasn't moved too rapidly, because people need to overcome those orders before moving the price. In day trading, especially on futures like NQ, forex or crypto, liquidity mostly comes from two types of orders. The first one is stop loss. A stop loss is simply a protective order trader places to automatically close their position if the price moves against them to a certain level. It is there to cut losses before they get too big. The second one is pending orders sitting at obvious levels. These are orders that are already placed in the market but haven't been filled yet, like buy stops above a high, sell limits at resistance or breakout orders. They are just waiting for price to reach them. When a lot of these orders, both stop losses and pending orders, are clustered together in an area, we call that a liquidity pool. There are two main types of liquidity pools that professional traders watch every single day: sell side liquidity and buy side liquidity. Let's start with sell side liquidity, or SSL. Sell side liquidity lives below the current price. It is made up of two main things. First, stop losses from long traders, people who bought and placed their stop just below the support or previous lows. For example, you can see in the diagram, if people enter long position at green arrow, they will likely put their stop loss below the red line. So if the price breaks through the red line, it will trigger all the stop loss and sell the position. Second, pending sell orders sitting at those same levels. Using the same example, at the same level of breakout, there are likely some pending sell orders that want to catch the breakdown trend and sell. When price drop down and sweep these lows, it triggers all these stop loss. Suddenly, there is a big wave of selling hitting the market. This creates liquidity for big institutions and smart money to buy into. Think of it like this. Retail traders love putting their stop at obvious places, just below the low of the day or below last week's low. Smart money knows exactly where these stops are sitting, so they push the price down there on purpose, grab all the liquidity by triggering all these stop loss, and then reverse the market higher. This is what we call a liquidity sweep or a stop hunt. It looks like a breakout to the downside, but it is actually just smart money filling their buy orders. Now let's talk about the other side, buy side liquidity, or BSL. It is actually the same mechanics with the above one, but in opposite direction. Buy side liquidity sits above the current price. It comes from 1. Stop losses from short traders, people who are short and have their buy stop sitting above resistance or previous highs. 2. Pending buy orders or breakout orders above all those highs. When price volleys up and takes out all these highs, it triggers all the buy stops. That creates a burst of buying pressure. Smart money can use that liquidity to sell into, as they are distributing their position at the higher prices. Again, this often looks like a strong breakout to the upside, but very often, right after sweeping the buy-side liquidity, price reverses hard to the downside, On the screen right now, you can see clear examples of both. Equal highs usually have buy-side liquidity resting above them. Equal lows have sell-side liquidity resting below them. These are the levels smart money targets every single section. Let's look at a real-life example so that this can be crystal clear. Look at this move here. Price was grinding higher, then it suddenly shot up and took out the previous high. A lot of traders who were short probably had their stop loss sitting right there. Boom! All those buy stop got triggered. What happened next? Price reversed sharply and dropped. That wasn't random. That was price sweeping buy-side liquidity, so that smart money could sell. The same thing actually happens on the downside. Price break a low, and then trigger all the sell stop from the longs, and then reverse to be higher. This is why you see so many fake outs at the open, especially on NQs during the first 30 to 60 minutes of the New York sections or during the London Open in forex. These are high liquidity times when smart money actively hunts these pools. So how do we actually trade this instead of getting trapped by it? Here's a simple framework that I use. Step 1. Identify the liquidity pool. Mark out obvious equal highs and equal lows on your chart. Previous day high or low, weekly high or low, and section high or low are the best places to start. Step 2. Wait for the sweep. Don't enter before the sweep. Let price take out the liquidity first. This is the inducement phase. Step 3. Look for confirmation. After the sweep, watch for strong displacement in the opposite direction. For example, big candles closing back into the range, or price breaking a short-term structure. Step 4. Look for entry models. Many traders combine this with order blocks or fair value gaps. For example, price sweep the sell-side liquidity, and then pull back into a bullish order block or FVG, and then you look for long entries. Your stop goes just beyond the sweep low or high, and your target is the next opposing liquidity pool. This usually gives you excellent risk to reward. Now, let's talk about the mistake I see traders make all the time with liquidity. Mistake number 1. Entering before the sweep. You see price approaching a high or low and you jump in too early, hoping it will reverse. Then the price sweep your stop and you get stop out before the real move. Mistake number 2. Ignoring the higher time frame liquidity. Remember, always check the daily and 4-hour chart first. The big liquidity pools on higher time frame are the ones that really move the market. Mistake number 3. Not having a clear invalidation. If the price sweeps the liquidity and then continues in a direction instead of reversing, your idea was probably wrong. So get out quickly. Don't marry your bias. And finally, never forget risk management. Even with perfect liquidity concept, you still need proper position sizing and a max daily loss limit. Prop firm or daily retail traders especially need to respect this because it will easily blow your account if you haven't do the stop loss properly. So, let's quickly recap what we have covered today. Liquidity pool forms where retail traders place their obvious stop losses and pending orders. Sell-side liquidity sits below price, and buy-side liquidity sits above the price. Price often sweep these levels to grab liquidity before reversing. Smart money use these sweep to fill large orders. The highest probability trades come after the sweep, but not before it. If you understand this concept, a lot of the market's random motion will start to make sense. If these videos help you, drop a like and comment the word liquidity below. I'll know you have watched all the way to the end. Subscribe if you want more videos on order flow, NQ trading, and smart money concepts. Thanks for watching, and I'll see you in the next one. Trade safe, and have a nice day.